All right, what's up, guys? So today we're going to be talking about what is a breaker block in context of ICT and his concepts. So a breaker block is the main point of today's video, and we're going to get right into it because we don't need to waste any time. So the definition of a breaker block is a failed order block. Failed order blocks that are closed above post liquidity sweep. So first of all, liquidity sweep. That's number one. Number two, we have to have an order block that we want to see price react from. Number three, is it closed above? So a failed order block because it is closed above and it's after a liquidity sweep. Number two, why is this important? This is a key concept in ICT methodology for identifying potential reversals and ranges for those reversals. So we have to understand that in order to find a reversal, there are certain characteristics that we're going to need to gain hindsight notice of and then implement it into the live action of markets. So how does this breaker block implement into market structure? So breaker blocks signal a shift in the dynamics of the market and the institutional interest and order flow. It also is a potential market structure shift, and it holds more power than a market structure shift because it's not just a shift in the market, it's an order block that we'd like to see price move in one direction being failed, closed above, and then we can use that to our advantage for price moving higher. So the anatomy of a breaker block. So there's three components of the breaker block: a failed order block, a liquidity sweep, and then price closing in the opposing direction of the original order block. This is pretty simple to understand, right? First of all, we need a liquidity sweep. So we find, like in my previous video about liquidity, we find good buy side and sell side levels. From there, we are going to watch those levels, see the level be swept, look for no displacement under the level or above the level, and then we look for displacement in the opposing direction. In the opposing direction, we're looking for an order block. We're looking for that order block to be failed by a price closing, right? There's a visual representation on a chart, is a reversal pattern where price breaks through the previous order block, right? So we're showing displacement through an order block. This often appears as a strong candle closing beyond the high or the low of the failed order block. So we can tell the order block is failed once price is closed above and below. That is a breaker block, but we like to put in more context, which is the liquidity sweep. So the liquidity sweep gives us validation for a potential breaker block. The key characteristics to identify these is occurring after a significant price movement. So we get a big drop lower for 2 days and we're looking for a potential reversal. That is when we can look for a good breaker block. That's when we'll look for sell side levels to be swept. Forms when an order block fails to act as support resistance. Pretty self-explanatory. When an order block does not work, that is when we can see a potential breaker block formation. Typically found following a market structure shift. So if we go on the lower time frame, if we're looking for breaker block entries in the 5 minute, on the 1 minute, we may see a potential market structure shift that we could give us validation for a potential breaker block being formed, aka an order block being closed above. This typically can be confirmed on both higher time frame and lower time frame, so it doesn't matter what time frame we use them on. All candles, price is fractal. That's a very important methodology when we're learning ICT, is price is fractal. So 1 day chart, 1 week chart, 15-second chart, all the same thing. It really comes down to how good your liquidity levels are. Like, are you finding liquidity levels that are high probability or low probability ones that are just simply formed a couple minutes before, right? So this breaker block then acts as a new support and resistance level in the opposing direction of the original order block. So this is where we kind of get a little bit more advanced, but the relationship between breaker blocks and actual liquidity. So liquidity sweeps create breaker blocks. So liquidity sweep triggers stop losses, right? That's what we already know. Price moving under a low or above a high triggers people's stop losses, so price will move in the opposing direction of the original order block. We have the failed order block, which then becomes a breaker block, right? Due to the liquidity sweep and the nature of the institutional order flow, price will have enough displacement and liquidity to move higher or lower depending on it, and closing above below the original direction of the order block that we'd like to see it. This, all in all, will signal a shift in the market structure, giving us validation for a potential reversal. So the role of smart money in forming these breaker blocks is, right, exploiting the retailer's stop losses. So the higher the lows, the buy side, sell side levels being swept is the retail trader stop losses being exploited. pushing price through these order blocks, creating reversals in the market direction, and we use breaker blocks to initiate significant price movements, right? So this is a main concept and theory in ICT's realm, and whether you like it or not, we can use it to our advantage. And if we see it really working within the markets, there's no reason not to use it to your advantage. So let's see the connection between external and internal range liquidity with relationship to breaker blocks. So within external range liquidity, breaker blocks are formed after sweeping external liquidity pools, right? So we have an external liquidity pool swept, and that's when we're going to be targeting the internal range. So internal range is used to build the position before the breaker block formation. Actually, this is incorrect. We use internal range to target. So the external range is the formation of the breaker block, and the internal range is what we target through the breaker block. So breaker blocks versus order blocks. This is a very big misconception that people have, that some breaker blocks are order blocks and some order blocks are breaker blocks, so we'll get into it. So a breaker block is a failed order block, which is obviously signaling a market reversal. This forms when price breaks through the previous support and resistance level and closes above an order block, and we use it to enter trades in a new trend direction, not the current trend direction, which is what order blocks are for. We use it to find potential entry points for trend continuation. So the main point between a breaker block and an order block is a breaker block is used for new trend direction trades. Order block is used for continuation trades. So these often precedes a strong price movement in one direction, right? So we're getting price movements in one direction, and we're going to continue those, so we're trend following. And this is what it looks like. So we have this order block right here, right? Because price closes above it. This is a bullish order block. So what we're looking for is if we're trading this as an order block, we're looking for price to bounce off of this level, right? Because this is our order block, so we're looking for price to sell, buy higher. But what we notice is there's a high right here that price has swept. So we use this to our advantage because we see the sweep in liquidity, so we can understand that this order block might fail. So once it fails and it's closed below, this is now a breaker block, and we can short from here towards external range liquidity, right? This is external range liquidity, shorting off of here into the internal/external. So trading strategies using breaker blocks. Number one, entry strategies based on breaker blocks can be found off of the close of an order block. So right as the close, signifying the creation of the breaker block. And then we can add or potentially start our trade with a retracement into the first fair value gap formed after the formation of a breaker block, which is also known as the unicorn setup. The unicorn setup is a breaker block being formed, the first fair value gap after, along with a tap back into the retracement back into the order breaker block, is our unicorn setup. So risk management, stop losses. So our stop will be found on the low or the high that created the breaker block, the manipulation leg that formed the liquidity for price to move and close above or below. So price closing below or above the breaker block gives us confirmation to exit the trade. So obviously if we go back here, this is our breaker block, and if price closes above here, we now have enough confluence to exit the trade, just due to the fact that the closure signifies a potential either choppy situation or price moving higher. So common mistakes within breaker blocks trading is, number one, over trading based on weaker breaker block setups. So the most of the losses that I see within breaker block trading is without proper confirmation within the breaker block, and just not the right liquidity pools being swept, and lower time frame coinciding over the higher time frame, ignoring the broader market context, which is pretty much what I just said. But losses can come from failure to consider the higher time frames and the overall market trends, which is the main thing. The backbone of ICT concepts is we go from a high time frame to a low time frame, and when those all align, that is when our trade is the highest probability. So now we're going to go into examples. So we got through the actual explanation and understanding of breaker blocks really quickly, and that's what I like to see here. And now we're going to get into how we apply it to the real market. Oh, I see a coyote. I'm outside right now. It's like 9 o'clock. So right here we have an up close candle, close below, which will then be our order block, right? Because it closed below, and so we'll use this to sell lower. But what we see is price swept the low, right? Swept this low, and it is during 10 a.m. So we have high probability for a 10 a.m. reversal, which is what we like to see. So once we see there's no real displacement below the order block, we can already start to predict a potential breaker block formation. So once it is actually formed, right, with a close above, and a retracement back in with a tap back into the failed order block, aka the breaker block. That is where my entry begins. So I enter in there. These are all real executions that I've taken. I obviously, in a real perfect world, you'd like to enter right here, right? But I entered off the entry right back into the high of this range, right? The fill was a little bit higher, and my target was this external range liquidity, right? External highs here and here. Price moved to those highs with displacement and quickly, and what we can see is that there was not much choppiness, and this is due to the fact that we had the choppiness here, and there is now the breaker block formed, so we have confirmation that price should go higher. Wow, this coyote is pretty close to me. Spooky. Yeah, and it's all foggy around here. Okay, next one. So here we have reaction to the consequent encroachment of this wick. We have an inverse fair value gap being formed, right? We can use this, as my previous video stated, we can use this to our influence. So price comes back down in, see quick displacement off of it. So now we're looking for a potential order block to be failed for our move higher. Obviously you can find an entry off of here, but I would like to wait for more confirmation, which in fact is the breaker block. So we have an order block here, right? Price closes below this candle, signifying an order block being formed, showing no displacement from it. I mean, obviously it came back in and moved lower, but once we see these two wicks, right, one wick and two wick, that is enough confirmation for us to go long, or for us to be long based, not going long off of there. We have a small inverse fair value gap right here, so price inverses it. Keep this in mind, that if we see a retracement back into here and a close above the order block, this would be a breaker block plus IFVG setup. So price comes back up, closes above. You can find your entry here, but I was waiting for a potential retracement back into the equilibrium of this range with closes. So once price comes back in, I found my entry here, and take profit was the external range liquidity and the 3.5 to 4 standard deviations of the manipulation, which was this range right here. So that was a good trade, right? We understand that this is a high time frame trade. We have this is a sweep of liquidity. That's all sweeping liquidity. Here we have a sweep of liquidity right there. We have order block formed right here. Right, there's a clean order block, price closes below. We're looking for rejection from this order block. We see small rejection, but we understand that there was a sweep in the higher time frame context, so we understand price will want to come to this high inside of a fair value gap, because this is high probability for highs inside of fair value gaps to be swept or hit just as displacement. So price closes above the order block, signifying a breaker block being formed. Now we're waiting for a retracement back in. Price retraces back in. I was looking for this order block to be tapped in, right? So once it was tapped, I entered the trade. My stop loss was below the breaker block. So looking for a close below the breaker block. Yes, I could have had my stop loss below the low here, but seeing the size of this breaker block, I would not want to see it close below, because that would signify a potential incorrect trade, right? Price quickly moves to our take profit, and this was a good trade. And finally, this was a high time frame one, and this is one where you can kind of get a little bit more sloppy on the high time frame, just because it takes longer for the candles to close. So what we notice here is there's a buy side here. Buy side is swept. We show displacement under, inverse fair value gap, inversed, huge candle down. What we see here is this is an order block that was formed. We would want to see price reject from here if we were following the trend continuation, which is what order blocks are for trend continuation, right? Price closes below, signifying a failed order block or a breaker block. Breaker block because there was a sweep first and then an order block failed. And once price comes back in to tap inside of this breaker block, I'm going to find my entry, right? We get a big move higher. This is a unicorn because there's a fair value gap right here. So fair value gap inside the range of an order block is a unicorn setup. So that was good, and that was my trade for the day. Thank you guys. My girlfriend's calling me now.